Welcome to Smart Wealth with Joshua.
Your daily stock analysis and catalysts talk. Today we're looking at ALM brand.
If you find our talks useful, please consider subscribe, like, and comment underneath. All right, so let's get into this.
Let's do it.
We're looking at a stack of reports and financials today that, honestly, they tell a pretty surprising story.
They really do.
We're talking about a company that it seems like a lot of the market is just sleeping on, or at least, treating with a lot of caution. Meanwhile, the numbers suggest they've quietly become a powerhouse over the last 12 months.
It's definitely a situation that rewards a closer look. We're diving into ALM brand, specifically looking at where they stand right now, here in January 2026.
And the timing is key, right?
Absolutely. The reason we're pulling this file today is because the full year 2025 performance numbers are in, and they paint a picture that is just vastly different from what the current stock price might lead you to believe.
Different is a very polite way to put it. I was looking through the notes on their revenue growth, and I think I'd use the phrase absolutely crushing it.
Well, that's not far off.
But let's not get ahead of ourselves. For anyone listening who hasn't looked at a Danish insurance ticker in a while, give us the elevator pitch. Why this stock right now?
The headline really is all about execution and just exceeding expectations. ALM brand has delivered massive growth.
Yeah.
If you look at the top line, we're talking about an 11% jump in insurance revenue. But the real story isn't just that they're growing, it's that they're significantly outperforming the targets they set for themselves.
Right.
They closed out 2025 with an insurance service result of DKK 1.91 billion.
1.91 billion. And just to put that into context for everyone, that isn't just a missed it by an inch kind of beat.
Not at all.
That is well above what they told the market they were going to do.
Exactly. And that is really the core of the thesis here. It's actually quite rare to find a company, especially in the insurance sector, that doesn't just meet its targets but completely vaults over them.
It is so volatile.
It is. You have weather, you have claims, you have regulatory changes. So when a management team sets a bar and then smashes right through it, that signals a level of operational discipline that we really, really like to see.
I mean, I love that under-promise and over-deliver approach.
Yes.
It's the golden rule, right, for managing expectations.
Exactly.
But I really want to unpack this because I need to understand how they did it.
Right.
You mentioned that 11% jump in revenue. And in insurance, you can get revenue just by jacking up premiums.
Sure.
So is that what happened here? Is this just inflation, or are they, actually winning new customers?
It's a bit of a mix, but the quality of the growth is actually very high.
Okay.
If we look at the revenue story for the full year 2025,
Okay.
total insurance revenue hit DKK 11.8 billion. Now, the specific driver here, and this is what makes it so impressive, is the personal lines insurance. That segment alone saw an 11% increase.
Personal lines. So we're talking about the bread and butter stuff, right?
Yeah.
Car insurance, home insurance, the policies everyday people buy.
Precisely. And you have to understand the context here. Personal lines is a very mature market. It's a dogfight out there.
Yeah, everyone's got it already.
Most people already have insurance. To get double-digit growth in that sector usually means you have to steal customers from someone else. It's basically a zero-sum game.
Right. People aren't suddenly buying 3 car insurance policies for 1 car, so they must be taking market share.
They are. And what's even more telling is the organic growth figure. Across the entire business, organic growth is sitting at 8%.
Okay, let's pause on that term for a second. Organic growth is a buzzword we hear constantly. Why does that specific 8% figure matter so much here?
It matters because it strips out all the noise from acquisitions. Sometimes a company looks like it's exploding with growth simply because they bought a smaller competitor.
And just added their revenue to the pile.
Exactly. That's bought growth. Organic growth means their core business is healthy. It means existing customers are staying, they're buying more coverage, and new customers are signing up because they actually prefer the product.
So it proves the demand is real, not just some kind of financial engineering.
You've got it. They aren't just buying their way to the top, they're earning the growth.
But here's the thing. Selling more policies is great, but revenue is vanity, profit is sanity, as they say. Just because you're bringing in more cash doesn't mean you're keeping it, especially in insurance where one bad storm can wipe you out. What's driving the profitability beyond just, the volume of sales?
That is the billion kroner question. And the answer lies in what we call the efficiency engine, or the synergies.
Ah, okay.
This is where the internal mechanics of the company really shine. Oh, man. Brand has been laser-focused on cost control. They are currently on track to realize DKK 600 million in annual synergies.
600 million. That's a massive number to just shave off your expenses. That's not like cutting a few coffee machines in the break room.
No, this is structural. That's merging IT systems, streamlining back-office operations, optimizing how claims are processed.
I see.
And the beauty of cost synergies is that they drop straight to the bottom line. So when you combine that 8% organic growth, more money coming in, with DKK 600 million in cost savings, less money going out, you get a margin expansion that's really powerful.
And we saw this play out.
We did. We
Yeah.
saw this in the second quarter of 2025 specifically, where they posted a technical result of DKK 20 million.
Technical result. I know we try to keep the jargon to a minimum, but in insurance, this one is vital. Can you just explain what that actually tells us versus just, say, net income?
Sure. Think of the technical result as the pure profit from the insurance operations themselves.
Okay.
It's the premiums collected minus the claims paid out and minus the admin expenses to run the business. Crucially, it excludes investment income.
Ah, so it ignores how well their stock portfolio or bond holdings did.
Precisely. That's an important distinction because, look, insurance companies are basically giant hedge funds attached to an insurance policy.
Right. If the stock market rallies, their net income looks great, even if they're terrible at actually selling insurance.
Exactly. So a positive technical result means they are making money on the actual business of insurance, on assessing risk and collecting premiums. It proves the core business model works without needing a bull market to bail them out.
Got it. So strong technical result equals a healthy engine. If it's weak, they're just relying on investment luck.
Correct. And here, the business model is working beautifully. And this brings us back to that guidance upgrade history I touched on at the start.
Oh yeah, this is my favorite part of the story.
It's great from a behavioral finance perspective. So leading up to the end of 2025, they upgraded their guidance for the insurance service result to a range of DKK 1.55 to 1.6 billion.
Okay, so they raised the bar. They said, hey, everyone, things are going better than we expected. We think we're going to hit 1.6 billion.
Right. Now, usually when a company upgrades guidance, they're playing a game of expectations. They try to just barely hit the top end of that new range.
So they can say, we did it.
So they can say they did it, but ALM brand upgraded to 1.6 billion max and then actually hit 1.91 billion.
Wow. So they upgraded and they still sandbagged it. That is just wild.
It's incredibly rare. It suggests that the momentum in the business was accelerating faster than even management felt comfortable admitting publicly.
Or maybe the synergies, the cost savings were kicking in faster.
That's the other possibility. Either way, for an investor, that is a massive signal of strength. It shows a conservative management team that prefers to surprise to the upside.
I will take a conservative management team over a hype machine any day of the week.
Okay.
So we've got soaring revenue, costs coming down, management smashing their own targets.
Mm-hmm.
Let's talk about the price tag. Usually when a company's doing this well, the stock is expensive, right? Everyone knows it's a winner, so you have to pay a premium.
You would think so, but this is where the deep dive gets really interesting, especially for the value investors listening.
Let me guess. You're about to drop an acronym on me.
I am. The PEG ratio.
The PEG ratio. Okay, let's unpack this for everyone. We all know the PE ratio, price to earnings. That tells you how expensive a stock is relative to what it earns today. What does the G add to the mix?
So the PEG ratio takes that PE ratio and it divides it by the company's earnings growth rate. It's essentially asking, how much are you paying for each unit of future growth?
Okay.
A PEG ratio of 1 is usually considered fair value. It means you're paying a fair price for the growth you're getting. Anything below 1 is considered cheap.
Right. Below 1 is cheap. So where is ALM brand sitting? 0.8?
Point though. Their PEG ratio is sitting at 0.13.
0.13. Wait, are you sure that's not a typo in the report?
Why not a typo?
That sounds incredibly low. That's basically 0.
It is incredibly low. A PEG of 0.13 is exceptionally rare for a company with this kind of stability. It suggests the market is almost completely ignoring the growth potential.
So it's pricing the stock as if it's going to stagnate forever.
Exactly. Despite the fact that they just grew revenue by 11% and beat profit targets by hundreds of millions.
That is actually kind of shocking. When I see a number that low, my skepticism radar goes off. It usually means cheap for a reason.
As it should.
Is the company about to go bankrupt? Is there some hidden debt bomb?
That's the first question you should ask. But looking at the financials, the answer seems to be no. The financial health score from our sources rates them as good, with a score of 2.86.
Okay, so that indicates a sturdy balance sheet, good cash reserves.
And a low risk of financial distress. So it's cheap, but it's not cheap because of impending doom. The cash flow backs that up too. The financial statements show strong cash generation. They aren't just booking paper profits, actual cash is coming in the door.
And what are they doing with all that cash? Are they just sitting on it?
No, and this is another green flag. They are reinvesting it. We're seeing money go back into growth initiatives, specifically partnerships and repricing efforts.
So they're feeding the engine.
They're feeding the engine that created this growth in the first place. They aren't resting on their laurels.
That's good to hear. You want management to be hungry.
Mm.
But let's talk protection. We always talk about the moat. What keeps the competition from just coming in and stealing their lunch? You said earlier insurance is a dogfight. And honestly, it feels like a commodity, right? I can switch my car insurance in 10 minutes on my phone if I find a cheaper rate. What protects them from that?
That is the common perception, that it's easy to switch. But in reality, ALM brand has built some pretty high switching costs, and they've done it largely through their strategy of strong bank partnerships.
Bank partnerships. Walk me through that. How does that stop me from switching?
Well, think about how you manage your money. If your insurance is tied to your bank, or it's bundled with your mortgage and other financial products, the friction to leave becomes much higher.
It's not just clicking a button anymore.
It's not. It's about untangling a whole financial relationship. These partnerships act as a funnel, feeding them customers who are naturally stickier and less likely to jump ship just to save 50 kroners a month.
That makes a lot of sense. Convenience is a powerful drug. If it's integrated with my bank app, I'm probably not going to mess with it unless I have really, really terrible experience.
Exactly, and that helps them capture and hold market share. But the moat isn't just about trapping customers. It's also about being more efficient than the other guys.
Okay.
We talked about those operational synergies. A great example is the claims ratio. They managed to improve it by 0.7 to 0.8 percentage points year over year.
Which means they're paying out slightly less in claims relative to the premiums they collect. Is that just luck? Or is that better underwriting?
It's likely a combination of better risk selection, choosing customers who are less likely to crash, and just handling the claims more efficiently. When you improve that ratio by even less than 1% on billions of kroners in revenue, that's a huge amount of money saved.
Yeah, that adds up fast.
And we're seeing this resilience even in the tough spots. Take commercial lines, for example.
Right. I did make a note about commercial lines, the business insurance side, having some issues with clients leaving.
There were some client drags, which is a nice corporate way of saying they lost some business or had some churn. But despite that, premium growth in commercial lines actually rebounded to 5.3%.
So even with some big clients walking out the door, they still grew that segment by over 5%.
Yes, that shows the underlying strength of the portfolio. They can take a hit, lose a few battles, but still win the war because the rest of the business, especially that personal lines engine, is pulling its weight. That is the definition of a robust business model.
Okay, you are painting a very rosy picture here. And as much as I love a good success story, my job is to be the skeptic.
Of course.
So let's play devil's advocate. What's the bear case? What could go wrong? Because a peg of 0.13 makes me suspicious that the market knows something we don't.
It's a fair question, and there are definitely risks. The biggest one is simply the nature of the business itself. Weather.
Mother Nature.
Insurance companies are always at the mercy of Mother Nature. If we get a year with terrible storms, flooding, or freezing, that beautiful technical result we love so much can get wiped out fast.
Right, you can't synergy your way out of a hurricane.
Exactly. And then there's inflation. Specifically, inflation in motor repair costs. This is a quiet killer for insurance margins.
Oh, that's a big one. I had to get my bumper fixed recently, and the cost was just insane compared to a few years ago.
It's not just the parts, it's the complexity. Cars are computers on wheels now. A fender bender isn't just bent metal anymore. It's sensors, cameras, calibration.
Right.
This inflation puts immense pressure on their ratios. If the cost to fix a car goes up 10%, but your premiums only went up 5%, your margins get squeezed immediately.
That's a real headwind.
Yeah.
And what about that client churn in commercial lines you mentioned? Is that a red flag that could get worse?
It's something to watch. The slow growth there was caused by specific large client discussions, while it is showing signs of manageability.
With that rebound to 5.3%.
Exactly. But if that churn accelerates, if big companies start leaving en masse, that could be a significant problem. Losing one big commercial client hurts a lot more than losing a few individuals.
So we have weather, expensive car repairs, picky corporate clients. Those are legitimate risks. But, and here's the twist, You mentioned earlier they upgraded their guidance. Does that mean they aren't worried about this stuff?
It implies they've managed it. Despite these known risks, the company seems to have priced them in. Their upgraded combined ratio guidance is around 84, excluding runoff.
A combined ratio of 84, for those who don't speak insurance, anything under 100 means profitable underwriting, right?
Correct. And an 84 is stellar. It means for every dollar or krone of premium they take in, they're only paying out 84 cents in claims and expenses,
Leaving a 16% profit margin on the underwriting alone.
before they even invest the money. If they can hold an 84 combined ratio despite inflation and weather risks, that tells me they are pricing their policies correctly.
Okay, so the risks are there, but the ship is built to handle the waves. Let's talk about the goodies for shareholders. What about putting cash directly in my pocket? What's the dividend?
They're definitely taking care of shareholders.
Hmm.
For 2025, they've confirmed a recommended ordinary dividend of DKK 0.66 per share.
0.66. Is that a decent yield in this environment?
It's a solid return, especially when you consider the capital appreciation potential from that low valuation. But there's an additional kicker here: investment income. They guided for around DKK 250 million in investment income beats.
So the stock market has been kind to their portfolio as well.
Exactly. When the broader markets do well, their bottom line swells, and that DKK 250 million acts as a nice buffer or a potential bonus for future capital distribution.
So we have a dividend, investment upside, and a core business that's humming along. Looking ahead, it's January 2026. What are we watching for next?
The immediate focus is the Q4 2025 results. They're imminent. We have the full year numbers generally, but the detailed Q4 breakdown will set the tone. More importantly, we need to hear the forward guidance for 2026.
Right, the big question. Can they keep this up? Or was 2025 just a fluke year?
That is the question. The macro context is actually pretty helpful right now. The insurance sector is benefiting from stable rates and a rebound in organic demand. This macro tailwind aids their pricing power.
Easier to raise premiums when the whole economy is stabilizing.
Much easier. So investors should be listening very closely to that 2026 outlook. If they project another year of synergy realization and stable growth, that PEG ratio of 0.13 is going to look even more absurd.
It sounds like we're sitting at a pivotal moment. The results are in, they're great, and now we're just waiting to see if the market finally wakes up to it.
I think that's a very fair assessment. The market is lagging the reality of the business performance.
All right, let's wrap this up. I need the final verdict. Give me a score and the thesis in a nutshell.
Okay. I'm giving ALM brand a bullish score of 8/10.
8 out of 10. That's a very strong score. You don't give out 8s lightly.
I don't. But the combination here is just too compelling. The summary thesis is this. You have high growth, that 11% revenue jump. You have extreme undervaluation, a PEG ratio of 0.13. You have strong financial health. And you have a clear strategy for market share gains via those bank partnerships.
It checks a lot of boxes. Growth, value, and a moat.
It really does. And on top of all that, you have a management team that has proven they can beat their own upgraded guidance. My target horizon for this would be a multi-year hold into 2026.
A multi-year hold. So this isn't a quick flip. This is a wealth-building compounder.
Exactly. Sit on it, collect the dividend, and let the efficiency engine do its work.
There you have it. An 810 for ALM brand, a company that's cutting costs, growing sales, and seemingly flying under the radar of the broader market. As always, do your own due diligence, but this one certainly looks like it deserves a spot on the watch list.
Absolutely.
Thanks for breaking it all down today. And to everyone listening, thanks for tuning in to Smart Wealth with Joshua. We appreciate your time.
Thanks for listening.
Don't forget to subscribe for the next analysis. We've got some more interesting tickers coming up later this week. Until then, stay smart and happy investing.
Bye for now.